Uh, of course, I have already mentioned that the lines between the counterparties are set up. An arrangement payment system of SWIFT is the most common system that is agreed, and test key and everything of that nature is common as conventional market and Islamic financial institution. Now that was slightly heavy perhaps for some who are not initiated into this. These are some general issues now. Islamic institution can deal with conventional banks or not? They can. The whole issue is, as long as the mechanism through which you are buying and selling, and hence all the details which apply is acceptable to the conventional institution, a non-Sharia compliant institution that applies, then dealings can take place as such. However, for Islamic institutions, the preference should be that Islamic institutions first deal with the other Islamic sister institutions rather than rushing to deal with the conventional banks. In some jurisdictions, in fact, in Malaysia, for example, they have banned this activity, that Islamic institutions should only place money with Islamic institutions, so the end utilization of that money should be Sharia acceptable as well. But Sharia wise, there is not a prohibition in dealing with conventional institutions, as long as the mechanism is exactly the same as for dealing among conventional institutions. Now, there are other financial instruments other than the one I have told you. As you can see that this commodity murabaha deal, as a murabaha which cannot be traded, you cannot sell it, this murabaha deal, to somebody else as such, and hence the liquidity is limited to the way I have described to you, which means the liquidity is there if you have a reverse murabaha agreement and you can have arrangement that way. Otherwise, this debt cannot be sold. Now, what are the other instruments which may be possible for Islamic financial institutions to hold? One of them is what is called sukuk, which is basically a certificate as such, but that can be traded if on the premise that it is asset backed and the majority are of underlying are assets, Sharia compatible, of course, assets, which in the case of many of the institutions will be a leasing portfolio. You can also have real estate, you can have equities, Sharia compliant, and assets of that type. There can be a minority, which will be 51% minimum should be assets, actually assets, and the other maximum of 49% can be debts like murabaha, istisna, and other financial instruments. So this whole portfolio is securitized, and then it is what you create, what is called sukuk. I will have something more to say under the resource mobilization, and this is the linkage between the two of the topics we are discussing: management of the liquidity and resource mobilization. So, but of course, these are not the sukuks of the institution itself. They can be any sukuk available in the marketplace. Normally, the sukuks are for longer duration. It's very rare to have a sukuk less than 3 years, but more issues have been made recently, which may be 2 to 3 years, but they normally have been 5 years. So, in other words, they are similar in nature as far as the market is concerned than fixed coupon or floating rate bond. A bond issued by a party promising to pay every 3 months or every 6 months a certain rate, fixed rate, or linked to some index, and that index can be LIBOR as such. So I think the issue there is of the what is the problem with that. Uh, Firstly, there is lack of liquidity. The number of issues in the marketplace is somewhat limited because these these are assets which funds, Islamic funds, Islamic banks, and others want to hold for a good return. As such, the liquidity tends to be poor because if you have 300 million issued and 100 to 200 million holders want to hold it to maturity, the freely tradable element left is much less, will be the balance. For these reasons, there is a lack of liquidity. And here in this section, we are talking about the treasury instruments, and hence liquidity is the main issue we are discussing right now. So, for sukuks in issuance currently are somewhat poor as far as the liquidity instrument is concerned. There is also a price risk under the normal market condition. The longer duration bonds, which means say 3 years to maturity, 5 years to maturity, the longer the period, the greater the price risk. In other words, if the yield or the return goes up or down by say 1%, the impact on the price of the bond is bigger the longer the maturity. This is another way of putting is this bond is more volatile or higher volatility. So for this reason, as a liquidity instrument, these are not good instruments because the price risk is much bigger and there is a lack of liquidity as such. Of course, they can be held in the investment portfolio of the treasury to earn high returns. So what we are saying in effect is that at a given point in time, the funds available to the treasury may be substantially more than what will be reasonably required over the period of 3 months, 6 months or a year. Treasury may hold more money than what it needs to give over a period of 6 months or a year. In that case, what happens to the rest of the money? The rest of the money can form what we may call investment portfolio. And for that, the sukuks, as they give high return, by and large, the longer the duration, longer the maturity, the return tends to be higher because also the risk component is higher as such. So sukuks play an important part in the portfolio as an investment in an investment portfolio managed by the treasury, but they are of course for the risks involved as well, they are less appropriate to be classified as liquid as a component of the liquidity. I quickly rush to what is a very important area for the treasury to manage, which is asset liability management. So you are going to manage asset liability. Liability is what you owe, assets what you own as such. In the case of the treasury, the assets will be, as I described, placements primarily, and 70 to 90% is under the same arrangement. And this is also a criticism of the Islamic system, that the banks have to hold a very large amount of money as liquidity, and the returns tend to be much lower as such. Islamic financial institutions, an IDB, Islamic Financial Services Board, which is an umbrella organization for setting standards, are looking at this issue to create liquidity management tools. So other than what has been existing today, we can create some instruments which can freely trade and create liquidity through a securitization process. Some work is going on, but the work is far from being finished, but we are very hopeful that sometime during the year, with the help of the regulators, a task force which has been set up will come up with some tools which can benefit Islamic financial institutions, with the aim of having a liquidity instruments which can be traded and which can also provide higher return than is available today. So of course this is a very crucial point. In order to meet disbursement requirements of the institutions concerned, placement of funds should ideally match the liability profile. So in other words, we need to pay money out after 1 day, 3 days, 7 days. Most institutions will run a kind of a table that what money is available, and that of course is a system through in the finance area, that the money has been given to various parties. The bank owns various investments, so the income from these previous financing has been done. There should be a profile of what the income is and when it's coming back, and when the capital is coming back. Some of the deals mature, so the money comes back. That should be carefully monitored, and you have a table. In one column you will have money coming back after 1 day, 2 days, 3 days, up to 7 days. Normally we look at daily position, what is known, and some of these are placements. So you have a overall profile of money coming in and money going out where the bank has done deals. In the nature of most of the deals which are there is no precise idea when the money may need to be disbursed, unless it is very much in the shorter term. So close eye has to be kept, and this is where the Treasury should have a strong contact with the business departments, so that they know when the funds are required, what is the size of it, and so techniques used for matching assets and liability by size as well as maturity. So if, of course, it will never match exactly, but for the first 7 days or 2 weeks, whenever this exercise is done, it should be positive, which means there should always be some money available to meet the liabilities concerned. Longer term, the bank may have a 5-year financing. So naturally, that is a different issue, that there will be periods in which you are not quite sure when the money is to be provided to the party concerned. But overall, asset liability management is a very important area, because the mismatching in overall terms. So you may have given money for 10 years, 15 years, and the available funds to you may be only shorter term, 3 months, 6 months, 2 years, 3 years. And as is commonly known, investors' horizon tends to be shorter term. So the investors may not want to have their money locked up for a very long period, where the rates of return change. Hence, the asset liability management, and I'm not going to go into details of it, look at the risks involved. If the liabilities are much higher than assets, and at what rate they have been. Because if the rates go down quite sharply, there will be one impact. If the rates rise, it will be a different one. And this has to be quantified as well. This is of course the risk of which is called price risk. There are credit risk as well, that some institutions may have a serious problem over the next 2-3 years, which we cannot identify now. But those institutions which are weak, then we have a problem of credit risk as well. So this whole area is a technical one. You quantify the impact on the overall bank by saying if the profit rates or interest rates go up by 1% across board, or in different sections. 5-year rates may go up different amount than 10-year rates, and then 2-year rates. In these changing market conditions, is my balance sheet safe, or if these scenarios change, whether the banks can lose a lot of money.